So depending upon the queries that I am receiving from you, I am realizing that we still need to discuss more about the base, the formation of the base, the colors inside the base, basically to answer the question how to determine stocks that are technically strong. The technical strength of the stock is very important, irrespective of whether it's a swing trade or a positional trade. So, the discussion that I'm going to do today is purely about the technicals of a particular stock. It applies both to swing trade and positional trade, and more to swing trade than a positional. In positional, at least you have fundamentals in your favor. In swing, we don't give much weightage to the fundamentals. So you have to be more strict with your technical criteria when it comes to swing trading. But let's back up a little bit and relook at the base, because a lot of subscribers are still confused trying to figure out how to draw the points, how to draw the color shaded base. So this is going to be an advanced discussion for those subscribers. If you still don't know how to draw the color shaded base, watch the video in which I discussed that color shading. If you still don't know how to draw the points in the base, that video I have placed in the homepage of this channel. Okay, let us start this advanced discussion. So let me draw a base for you first. So let's say here is a base. Okay, and let's draw the color shading of this base. So as you can see, let us discuss the green zone first. In green zone, uh, we need minimum 4 points in the base, right? Of course, in any base, we need minimum 4 points. But in green zone, we want at least 4 points. Blue zone, we want at least 6 points. Okay. So have a look at this base. This is the buy point, right? And this is the closing price. So when the buy point and the closing price both are inside the green zone, okay, that's relatively safer. That is relatively less risky. Now, why do I say relatively? Because when the buy point is in the green zone, you have another combination where the closing price could be in blue zone. So this is the next combination. The first combination is both the closing price, this is the closing price, and the buy point. Both are in the green zone. Here, the buy point is in the green zone, closing price is in the blue zone. By the way, this is the low of that candle. It's not the closing price, but that candle, the closing price, if it is inside the blue zone, that is what I am referring to. I hope you understand what I'm saying. So whatever candle is there here, the low of that candle becomes that point number 4. For that candle, if the closing price is in the blue zone, that's the scenario that I am talking about. This buy point is not the closing price. This buy point is actually the high of that candle. Okay, so you need to understand that nuance. When you draw enough bases, you will understand. Okay, so in green zone, you have two combinations, two types of bases. One base where the buy point and the closing price are in the same green zone. Second combination is the buy point and the closing price are not in the same zone. The closing price comes in the blue zone. The first scenario is relatively less riskier. Okay. So that is a discussion on green zone. I will come back to the green zone later in this video. This is just the beginning of the video. Okay. Now let's talk about the blue zone. Now in blue zone, we need minimum 6 points in the base to have a technically sound stock. Okay, so let's draw the base. So let's say you have a base that looks like this. Wait, let me remove all of this. Now let's focus on the blue zone. Okay. Now let's see how it looks like. So let me push this a little bit higher. I'll put this here. Okay. Now, just like in the green zone, you had two combinations. Similarly, in the blue zone, you have two combinations. The buy point and the closing price are inside the blue zone that represents tightness. That is what we want. The second combination is the buy point is in the blue zone and the closing price of that candle is in the red zone. That's the second combination. I prefer not to buy the second combination because it's too risky. Because from here, there is a lot of overhead supply coming, and I'm coming out of the red zone. It's too risky, basically. So I prefer this closing price to be inside the blue zone for that tightness. Okay, so you understand there are three combinations that we can buy irrespective of whether it's swing trade, positional trade, does not matter. We are purely looking at technicals here. There are three combinations which we can actually buy. Number one, the buy point and the closing price are both inside the green zone. Okay. Number two, buy point is in the green zone, closing price is in the blue zone. That is still okay, but riskier relatively than the first option. The third option is both the buy point and the closing price are in the blue zone, but that requires 6 points, remember. And also remember one thing that the distance between the buy point and the closing price of the latest candle should not be more than 5%. That's a cardinal rule. Imagine if the distance between the buy point and the closing price is 10%, and the next day the stock shoots up 11%. How much money do you make? You make only 1%, right? Because it took 10% for the stock just to reach the buy point. That is unfair. On a day when a stock shoots up 11%, you make only 1%, and there is risk there. After 11% rise, there might be consolidation, there might be profit booking. So you might lose money there. Okay. Next, if the buy point is in the red zone, just forget about the stock. It's too much overhead supply to handle. And remember always, the buy point will always be above the closing price of that latest candle. Okay, so if the buy point is in the red zone, obviously the closing price of the next candle is going to be in the red zone. So there is no question of discussing that scenario. The buy point has to be in the upper half of the base. That's it. And the distance between the 2 points should be less than or equal to 5%. It's as simple as that. Okay. So now you understand green zone, we need minimum 4 points in the base. Blue zone, we need minimum 6 points in the base. Green zone, you have two combinations of bases, the buy point and the closing price. Blue zone, you only have one combination that you can tolerate. Now, there is one exception to this. Sometimes what happens is there are only 4 points in the base. Okay. Inside the blue zone. So let me draw that. I will show you all the combinations in this. Now have a look at this base. See, the buy point is in the blue zone, closing price is in the blue zone. What's the problem with this base? The problem is the buy point is in the blue zone, and in the blue zone, we need minimum 6 points. But here there are only 4 points. So we cannot buy the stock, right? But there is an exception. You see the base, the height of the base, it's so small. Sometimes it is less than 5% from here to here. Sometimes it is less than 10% from here to here, right? So what I might buy the stock because it still satisfies our basic criteria of minimum 10 candles and 4 points in the base, right? It still satisfies that criteria. It does not satisfy our 6 point criteria inside the blue zone. But since the base itself is small, I might buy the stock provided it's a positional trade. You understand? When I am buying a stock with 4 points in the base, that to inside the blue zone, I am taking additional risk, right? To compensate for that risk, I am restricting myself only to positional trade where I look at fundamentals, where I give more weightage to fundamentals. So you notice how I am balancing the risk. This is called flexibility. The orange trading system framework that I have created, it allows for that simplicity and flexibility. If the base itself is like 4% in height, that's not much of a base, right? It's called a flat base. So in those cases, the points really don't matter because it's consolidating in a very narrow range. In that case, I might buy a stock with 4 points in the base coming out of the blue zone, provided the fundamentals of the stock are strong. Now, what if the fundamentals of this stock are weak and I am tempted to take the trade? Like my mind is saying, Rohit, you have to take this trade. Okay, because it's a swing trade. See, the fundamentals are weak and I want to take the trade. So by default, it's a swing trade. And my mind is tempting to buy the stock. What do I do? Well, I control the position size. I keep a tight stop loss. It's as simple as that. Again, coming back to the concept of flexibility, you can do these adventures, but while doing an adventure, you should be aware that you are doing that adventure. If you are not aware that you are taking risk, how will you control your position size? If you are not aware that you are taking risk, how will you keep a tight stop loss? If I am taking a swing trade on this kind of a setup, saying that the height of the base is small, I better keep the stop loss at point number 4, not at regular 8% because I am taking a swing trade and that too with only 4 points in coming out of the blue zone. Okay, remember that very, very important exception. So in the orange trading framework, I am allowing for that flexibility, but flexibility comes with risk. And if you have awareness of the risk, only then you will control your position size and your stop loss. A lot of students ask me stock specific questions. I cannot answer those questions because of regulatory reasons. I am not allowed to talk about stocks with the latest 3 months price data. So I am not able to answer your questions. I apologize for that. But I am giving you conceptual knowledge to help you understand what went wrong. If you have recently had a loss in your stock, check where was the buy point, where was the closing price, were you taking relatively higher risk, check the fundamentals of the stock. When you bought the stock, what were the fundamentals of the company? Were you taking additional risk? Was your mind overlooking something? That is what I can teach you, and that is what I'm trying to do here, to provide you education so that you can look back at your recent trades where you have incurred losses and you can spot the mistake. Okay, it's not a mistake, it is something that you just overlooked. Okay, next time you will not overlook that. Okay, taking this discussion further, this is more advanced discussion now. Okay, let me draw another base. Have a look at this base. Okay, let's draw the base here. So now you see, this is like icing on the cake. 8 points in the base, buy point is in the green zone, closing price of the latest candle is in the green zone. This is not the closing price, this is the low of that candle. Okay, but assuming closing price is in the green zone, 8 points in the base, that's a fantastic base. This is a Mark Minervini base, by the way. If you notice Mark Minervini's US Investing Championship 2021 trades, there are 19 trades that were disclosed publicly after he won the US Investing Championship. What I have done is I have taken all those 19 trades, documented those trades in a single video. In one video, I discuss all the 19 trades taken by Mark Minervini in that US Investing Championship. That video is available in my video course for my video course students. It's extremely valuable uh, video because we need to study how a champion looks at a particular stock. And you notice, if you are my student, if you have already done the video course, you notice that most of those trades have been this type of trades. Like this is like icing on the cake. More than 4 points in the base, plus buy point and closing price in the green zone. And sometimes I saw Mark Minervini taking trades where there are 8 points in the base inside the blue zone, extreme tightness. Only then he would buy the stock. Okay. I kept that video in the video course because, see, video course students pay a price to learn from the course to save their time. So I need to give extra additional value there. That is why I placed it there. I did not place it here. I hope you understand. But the point I'm trying to convey here is the more the points in the base, the less riskier is the base. The more the consolidation, the compressions in the base, less riskier the base. The closer the buy point towards point number one, the less risky the base. Okay. Now compare this base with, wait, I will remove this. Remember the base that I had drawn now. Now compare this base with this one. I think this I discussed in one of the videos. See, even this qualifies, right? 4 points inside the base. But do you see consolidations inside this base? No, it's just 4 points in the base. So people who bought here might want to sell the stock here. People who bought here might want to sell the stock here. So this is not a proper consolidation. It's like a V-shaped base. The previous base that I had drawn, if you rewind the video, it was not a V-shaped base. There were fluctuations inside the base. Those fluctuations are important to weed out the retail participants from that outstanding stock. Every company has a fixed number of outstanding shares. So when that churning happens, that the shares that retail participants are holding, they are slowly moving towards institutional participants, right? In that process, in that compressions, the retail supply is reducing. Here, the stock did not get enough chance for the retail supply to get retail shareholders to get out of the market, right? That is the problem here. So you might look at this kind of a base and you might get excited saying, oh, Rohit said 4 points in the base, green zone, let us buy the stock. Okay. Wait, look at the base carefully. Please study the base carefully. This is an advanced discussion. Sometimes students look at this kind of a base, see like this, and say, Rohit told that there should be 4 points in the base. The buy point should be in green zone. Fantastic, I got it. I'm going to buy the stock. Well, wait, think. Okay, I'm not saying don't buy. I am saying before you buy, think about risk. There is nothing wrong in buying. The problem is position sizing. Okay. If you look at this kind of a base and you put 20-25% of your portfolio in this stock, that is a mistake. But if you look at this kind of a base and if you put like 5 to 6% of your portfolio into this stock, that is not a mistake because that you went in with the awareness that you're taking additional risk. Same concept applies to blue zone. When you have fluctuations inside the base, that is a healthy sign. But if you'll have like a V-shape base, that is not good. Okay. So give the stock some time to consolidate. Let it form a proper buy point inside the green zone or the blue zone. Only then you can determine that it's a technically sound stock. The reason why I am discussing all of this is because even if this stock breaks out, okay, even if it breaks out, it will go up maybe 5-10% and it will collapse back again inside the base. See, you might think that you did made the right decision by buying this stock, but the breakout does not sustain because the consolidation has not happened properly. Okay, you need to understand that. Another thing I wanted to discuss is sometimes what happens is The stock, see like this, like wait. So sometimes what happens is the stock does like this. Now have a look at this. There are 6 points in the base. Both the buy point and the closing price are inside the blue zone. Now you might say, Rohit said 6 points in the base, blue zone, let's buy the stock. Okay. Wait, check after point number two, how many candles have closed inside the green zone? Not a single candle. Okay, one of the candle might have poked above that blue zone. Maybe the shadow is above the blue zone. It goes into the green zone, then it falls back. What does that mean? There is overhead supply here. The overhead supply is not allowing the stock to go into the green zone. And you are thinking that Rohit said blue zone, 6 points, let's buy the stock. Okay, give it some thought. Okay, there's nothing wrong in buying. Buy, but with not with controlled position size, controlled stop loss, because you are taking risk. You are you are confronting overhead supply. Okay. Now, if I move this here, let's say, let's draw another base. Okay, let's say like this, something like this. Okay, let's draw the base. Something like this. Okay, or something like this. Now have a look at these two bases. After point number two, it's important to know how many candles or how much time the stock spends inside the green zone. Here, the stock did not even enter the green zone. That's a problem because there is overhead supplies pushing the stock down. Here, the stock attempted to go into the green zone. Some churning happened there. The stock came down because of overhead supply. But in that process, a lot of retail investors came out of that stock. So it spent some time in the green zone, right? To absorb that supply coming in from these people and these people. Okay. Then it came down. Then it went to blue zone. Then now it's forming 6 points in the blue zone. Tell me which one is more risky. This base is more risky or this base is more risky? This base is more risky, right? Because it's not spending time in the green zone. This stock at least went into the green zone, right? So again, please understand there are nuances inside the base. This was an advanced tutorial lesson. This was pure technical analysis, right? Some stocks are so wild. Let me explain. I also got a question today. Somebody sent me an email. Let me draw that base too. Some stocks are so wild, they'll do like this, okay? Like this. That's a risky trade. Please understand that there is time compression happening here. Time compression is a concept explained by Mark Minervini in his second or first, I think the second book, Think and Trade Like a Champion. In time compression, what happens is the stock moves up very rapidly, giving very less chance for the retail participants to give away their shares to the institutional participants. That's too risky to buy, right? Because proper consolidation has not happened. Another scenario, sometimes what happens is like this. It goes up here, then it goes down here, like this, like this, like this, and suddenly it goes up like this. Well, the stock is spending majority of the time in the red zone. Please understand, and suddenly there is a buying buying pressure. There is buying demand coming from institutions, maybe. So proper consolidation has not yet happened. This again is a risky stock. Now you might say, Rohit, point one, 0.2, 0.3, 0.4, green zone, buy point in green zone, closing price in green zone. Fantastic. Let's take the trade. Okay, let's put 20% of our portfolio in the stock. Well, I have no prayer for you. Okay, please check the base properly. The stock is spending too much time in the red zone and there is a sudden spurt in price. This is not healthy price action. Okay, the most ideal base which I have drawn for you, and if you read Mark Minervini's book, most of the bases will look like this. Most of the bases in his book will look like this because that is called proper consolidation. In fact, in his book, he also goes on to say that every compression should be half of the previous compression. So if this is like 2%, this distance should be 4%, this distance should be 8%, this distance should be 16%. Please read that book carefully. So those compressions are important. Okay, you have to understand that. This is the most ideal base, ideal kind of a base that you can have. Okay, where each successive compression is half of the previous compression. That is proper base. Mark Minervini calls it the T's. Okay, every successive wave is almost half of the previous one. So I hope you understood this discussion on technical analysis. Very, very important discussion. I hope this will add value. I expect you to go back and look at the recent trades that you have taken and compare those stocks with what I have discussed here and see what is it that you overlooked. If the stock has come down, what could possibly be the reason, right? Hope this helps. Thank you so much.